In this video, guys, we're going to look at trading without stops and why stops don't work. Stay tuned. Hey traders, warm welcome to you. Thank you for joining me. Alright, so a bit of a controversial topic, this one, and by the way, no recommendation as always with all my videos. This is just some opinion, just some kind of ideas to get those juices flowing. Get the comments in the comment section because this is going to be an interesting topic. But I thought about this for quite a long time. I've done videos before about how to manage risk without stops and some ideas and things. And by the way, if you're new here, guys, this is the channel to be. If you love your trading, you love the markets, you're an active trader, so make sure you are subscribed. And while you're here, check out our channel sponsor. They're in the description below, or link to them in the description below. Okay, so using stops. So it's a fact that for most strategies, when they are back tested, if you put a stop component in, i.e. coming out and a loss at a certain level, whether it's a percentage, a number of ticks or whatever it may be, that generally, and I'm being generalizing here, generally has a negative impact on the outcome of the strategy. So if, let's say, they had some sort of strategy that said, after 3 up days on the Dow, we go short and we close it on day 4. If there's no stop, then that generally, most of the time, without fail, has a much more profitable or powerful expectancy. Yes, you get days where you get wiped out, but ultimately over time, over the long term, then that really is kind of to your detriment if you're using stops. So that's the facts, guys. We see this all the time in a lot of back testing. So what does it mean for us as sort of retail traders who are trying to kind of trade day to day or month to month, week to week, whatever time frame we're trading on? How can we manage that? And why do we use stops then? If stops don't work and we see it in the numbers, we see it statistically that really they have a negative impact on our trading, why are we using them? Well, the answer is, of course, is that we want to protect ourselves against loss. We want to, number one, protect ourselves against catastrophic loss. We're in a trade, all of a sudden Trump comes out and tweets something, some sort of news hits, bang, the market falls down 300 points, or 30 handles if you're trading the ES, ouch, you're long, it's going to hurt. But okay, let's think about that for a second. That's only going to hurt you, obviously, if you're long. Now, so we could assume you're 50-50 whether you're going to get hurt by that. And the other thing is, how likely is that to happen? Sometimes it's more likely than the others. I know we'll go through seasonalities where, we do have kind of market moving news coming out, headline, kind of things that are blasting the tape. But, in reality, is that really going to affect you? Yes, it will if you're on the wrong side of it, but put that to one side for the moment. What about other things? Now we come out, we use a stop loss where we say, potentially the trade is negated. I talk about that phrase all the time, and, I'm a big advocate definitely of using stops under certain conditions. We'll get to that in a moment. But let's just see why we're using stops in the first place. We're using a stop because we think that pattern is no longer valid. But a lot of us are using stops far too tight. We're forcing, I say, well, it's got to go to here. And really what we're saying is, the market's definitely not going to go to here before it goes to here. And so it's almost, if you think about it, and listen, guys, I do use stops for a lot of my trading. I'll talk about in a moment. I've had a little bit of an experiment with that, but we'll get to that towards the end. But you're almost being a little bit arrogant to say, oh, well, the market's not going to go here before it go here. You're trying to be very definitive and definite with it. And actually, all the market's got to do is touch that and you're out of the trade. And the probability of touch is half the probability of close, twice the probability of close. So the probability of it closing there is half the probability of it touching it. So it touches it doesn't mean it's going to close it. It's still 50-50. So, we're adding an extra weight to our trades. It's not that great. And so let's examine this. So stops are great for some setups. So like for some example, some momentum pulls back a little bit. You want that momentum to continue. And so a stop makes perfect sense because, if it doesn't continue and it pulls back more, then it's not momentum, it's just literally a spike. And so for some setups, definitely I think stops are great. For most, however, as we looked at, they're quite poor. If you're buying a pullback, then, does it want to go further? How does it go further? Might just have a little kind of bit of supply demand imbalance, goes down and pushes back up, you can get stopped out. So how do we manage the risk otherwise? We all want to manage risk. No one really wants open-ended risk. So how do we manage the risk otherwise? And one point here, guys, is that if you look at many really high-end professional traders, like traders who are trading with 8-figure plus accounts, they don't really use the stops in the way that we might trade. So the guys who are trading, 7-figure accounts, 6-figure accounts, 5-figure accounts, we trade slightly differently because the guys who are trading with a kind of big size generally will say, okay, this is the position. I have an emergency exit, so if everything goes wrong, that's my kind of, I'm going to wipe out point. And that could be as wide as, let's say 10 handles on the S&P, 100 points, 200 points on the Dow. And they then come out of the trade when they are ready to come out of the trade. So we're not saying here don't take losses, but they are using their judgment to come out of the trade rather than actually a finite point. And so that gives them the opportunity to say, right, I'm long here, for example, the market's come lower, I still think we're long, I'm using my judgment and skill and intuition and all the other things to suggest I'm long, and then it goes back up. That's great. If that had stopped, they'd be stopped out. Or they're saying, you know what, things have changed, I'm going to cut the position, I'm going to come back in a later date. So they're using their judgment to get into the trade, they're using their judgment to get out of the trade. They have an extremely wide stop for worst case scenarios. So it still protects them from that tail risk, potentially, and it allows them to kind of get involved with the market. So that does mean they take losses that they didn't otherwise wouldn't have wanted to take, but what it does mean is that they don't get caught by spikes. And if you look back at your trading, how many trades have you taken where actually the direction you had was right, but you just got stopped out a little bit early? And if you'd taken a little bit more heat on the trade, then it would have been fine. Now, I'm definitely not saying, guys, that we should all start to look at this and trade without stops, because that would be catastrophic for most people. Stops are there to protect us. But it does really raise the question that how we look at stops. Should we have wider stops with some kind of judgment in between? So if we're taking, let's just quickly draw this, if we're taking kind of classical pullback trade to here and we're going long around this kind of level, nice setup, nice kind of bread and butter type play, rather than us trying to be very clever with the stop, why don't we have a wider stop, a default stop of however many ATRs or something, and then say, okay, let me judge it. So when it starts doing business down here, you might say, it's gone quiet, the volume's gone lower, we haven't really got the momentum, I'm going to cut the trade. That's fine. Or you might go, oh, okay, actually, it still looks valid, the time of day is valid, or whatever else reasons you've got it, and you might hold the trade. The important thing is, you've obviously got to have the experience and kind of awareness to be able to make that judgment. The last thing you want to be doing is just sitting there and say, well, my stop is here, I'm just not going to close it. That's an emergency stop. That's for like, okay, something comes out and just rips your face off. But you need to still have the ability to cut losers and say it's not working, cut it, and look again. So it's definitely something for someone with a bit more experience, more screen time, more awareness, more understanding of the markets. And so that might be something to consider. How do we manage the risk otherwise? And also the size we trade. Very often traders with smaller accounts, let's say compared to some bigger 8-figure account type traders, there's a thing about trading size. More leverage is generally used, so more damage can happen. So maybe reducing the size a little bit, maybe experimenting with this and say, okay, reducing the size doesn't necessarily mean I'm going to make less money, it just means I'll take longer to make the money. You think about it, it actually can work in your favor. Yes, you might reduce your size. Let's say you reduce it in a quarter of your normal size just to allow for this occasional kind of really nasty trade, but otherwise it's working fine. Might actually improve your profitability because you make more trades that are profitable, but okay, they're not as profitable as the bigger trades, but it might mean that yes, you get to where you want to be with your goals of how much you want to make, but it just means a little bit slower potentially. Now that's not the end of the world, that's better than not getting there at all. So something to consider, reducing the size, having a wider stop, and being a little bit more perhaps giving you the ability to make the decision yourself between that level and that level. So between that level and that level, you can decide to come out. So smaller size and that. And what's the answer to huge loss exposure? Well, there's some people out there who trade with no stops at all. But I think that having kind of an emergency stop, so to speak, because ultimately, guys, things happen, and I think it allows us to trade a little bit more comfort, knowing that, hey, the worst case scenario is X. I don't want to hit that no, but it happens. Something might come out hits the market and your internet goes down and the kind of world seems to end for you. That's the last thing you want. You want to have some, I think, safety net in. And if you think about the amount of times it's going to come right down, and wherever that stop may be, it might be kind of one whole day's range under your level, or if you're trading intraday, it might be a whole week's range if you're trading kind of swing trading, or whatever it may be, but it's wide enough not to get pinged and get pinged maybe 1 out of 300 times or something. The point is it's there, and it shouldn't get hit often enough to have much of an impact on your trading. So you've got that safety net there. And then why we should consider a no-stop strategy, just purely because the numbers seem to show that. Whenever we look at backtesting data, adding stops, generally does really impede the performance. And so let's use that and let's go, okay, let's not disregard stops completely, because for most of us that's just not feasible. It doesn't make any sense. We're trading with account sizes where we need to kind of use the leverage to get the returns that we want to get, and so with that leverage comes the the potential for a big loss if we're not careful. And so maybe we can consider this. Maybe we can go, right, let's use that data and go, okay, well, I'll have a wide stop then. Let me really decrease my position size. And yes, that means every trade might not be as nice as I want it, but ultimately over time, maybe that's going to be better for me, because I'm going to be in trades that are really, would have gone my way anyway if I just sit through a little bit more. Maybe I was a little bit early to it, a little bit late, whatever this case may be. And then getting better at exiting the trade when it's not working without it hitting the stop. So understanding, we're not just going to cut it straight away, but really working on that aspect of it, really working on the point of, hey, I'm taking heat here. How do I come out of the trade? What signals do I need to look for? What things in the price action? What sort of whatever, however you make your trading decision. What sort of clues do I get this really isn't working? And you start to become a bit more expert at it, you start to become better, and then maybe you can start to look to tighten the stop up and say, well, actually, most of the time, these never go against me, 50 pips, whatever you're trading, so I can probably tighten the stop up a little bit. And I think, that might be something to look at. And by the way, guys, no recommendations at all, as always with these videos. It's just my thoughts, and I'm really interested to hear your comments in the comment section below about this, because this is a kind of thing that not many people talk about. Everyone says use stops, and I still think we should definitely be using stops, and definitely on some setups there's a time and a place for a tight stop because of the nature of the setup. But it might be something to consider, something to think about, okay, well, what about if I use a wide stop and reduce my position size? How is that going to affect my trading? So food for thought. I'm really interested to hear what you guys have got to say, and if you like this kind of stuff, want to investigate this a bit more, then hit the like button and let me know you like this kind of thing. Take care, guys. Keep your risk managed. Whatever you do, risk management is important. To the next one. Bye bye.